Right, Mitesh, thanks very much for that. We'll come back to you in a bit from now. Now, Devina Mehra is now joining us, founder, chairperson, managing director at First Global. Devina, it's a pleasure. Great to have you with us here on the program. Season's greetings from all of us here at CNBC TV 18. I hope you're having a good time at that time of the year. And thank you for being with us today. You wrote an article for Money Control. It was titled "Why Half Truths Can Be More Dangerous Than Outright Lies." And you gave some very interesting examples. As we head into and look into 2023, it's a time for predictions, right? I'll ask you to make a few in a bit. But as you look into 23, to your mind, what are the one or two kind of these half truths which are accepted as gospel, and that kind of need to be shattered, that needs a relook, in your opinion?
Hi, Prashant, and hello to viewers also. Right. Hi, good to be here. And actually, there are many, many myths in the markets, and the myths actually come out of the fact that we as human beings have many biases in our makeup. I mean, there is bias and there is noise, that even the same facts presented to you, as let's say if you are a judge or an insurance professional, or for that matter, a market professional, the same data presented to you one day and then presented a month later, you might come to different conclusions, let alone different people coming to different conclusions. So, one of the things which I highlighted in this article was that often people give all this data that if you had bought HDFC Bank in 1996, or Hindustan Lever at this time, or Tesla, or Apple, or whatever, then you would be worth so much. But there are many layers of myth in this. For one, many stocks which were considered blue chips earlier just went into nothingness. So if you look at, for example, if you look at the original Sensex list, that will have all this JK Group and Thapar Group and Mafatlals and Premier Automobiles and Hindustan Motors. Then in between, you had a lot of PSUs in the Sensex or the Nifty. So all these things, even if you buy the so-called blue chips of the day, it doesn't mean that there is any guarantee that 20 years later you would have compounded at a great level. That is one. But even stocks that have supposedly done well, if you look at the history of Apple, for instance, for a long time after its listing, it did nothing. Even 20 years after its listing, it had only doubled from the IPO price. So, this grand story is, first of all, a lot of stocks just fall by the wayside. So you are only looking at the survivors. And even those survivors may have had very checkered history. So that is something people, if I bring it down to a nutshell, in anything, you look at long-term data and you really look at it objectively, you will find things which people are just ignoring. And it goes always. Like if you look at the time of the Russia-Ukraine war, on that day, on the day the war broke out, we had done this analysis going back 40, 50 years, that every time there is a geopolitical crisis, the two Gulf Wars or 9/11 or US bombing Libya or Afghanistan, we said, let's see what happens to the markets. And we saw that before, during, and just after that event, there is turmoil in the markets. But 6 months, 1 year later, the markets forget about it. Other than the direct impact, like if oil supply is impacted or something is impacted, that is different. But stock markets around the world might react to that event, but they forget about it soon enough. So I'd actually make a prediction on the day the war broke out that in India, you will, 6 months later, it won't even show up, other than the impact through the commodities, which is the impact on the fundamentals of companies. So, there are basically, we always say that in data we trust. So you have to look at data for everything, and you will find that so many things that people believe are just myths. People ask me that you talk about your pick of HDFC Bank or Amazon. Tell us which is the next HDFC Bank or Amazon for the next 20 years. And the answer to that is that nobody has this crystal ball. Even if you would ask Jeff Bezos, when we put that strong buy on Amazon at $15 in 2001, or if you'd asked Aditya Puri after the IPO, they also would not have known that the stocks would compound the way they did. And which is why no investor in the world, the very best investors in the world, whoever you want to pick, whether it's Warren Buffett or Rakesh Jhunjhunwala or whoever has the greatest track record, you will find most of their money has been made in a handful of stocks. It's as low as, even in a 50-year career, like for Warren Buffett, it is just about 8-9 stocks. So, and no one knows which those 8-9 stocks will be. So the best you can do is have a good portfolio. And if you've chosen it well, maybe some of them will be multi-baggers, but you must also remember that some of them are going to be duds, which is why I, buy and forget, or buy and don't react, even if there is a huge drawdown, and just hold it through, or is very bad advice.
Okay. Devina, afternoon, fair enough. And there's always good money to be made in pessimistic situations, and that's what history has told us. In that article, you also make a reference to Asian Paints. Can you give us some more examples where the nuance in what's being sold to investors is lost in the storification, as you call it? What happened in the case of Asian Paints, and some other examples?
Yes, yeah, I mean, Asian Paints, of course, I mean, that was a particular thing that there's this news saying that Asian Paints delivers paints twice a day to its dealers, which if you go to any paint dealer, you will find out is not the truth. And the fact is they don't need to do that, because the paint is actually mixed at the dealer level. That's the technology. So they don't need to, decide that this Mere Wala pink is going to sell, and therefore I need to get this to this dealer in Kalba Devi in Mumbai. They don't need to. The dealer can mix it. So that is one part. But storification is a broader theme. Actually, the thing is that as human beings, we that this is stories are what makes us human. So if you look at all civilizations across time, across geographies, the one thing which is common is stories. We explain things through stories, we teach through stories, we remember stories, we don't remember data as well at all. So stories are great. For example, if a fund manager is selling a product to investor, and he or she explains that this is how I do it, or this is why I have bought this stock, and this is the story behind it, it's very good. But the markets don't care about stories. So I mean, for example, in 2020, I was on your channel when FMCG was all the rage, and there were all these fancy stories saying that this is a cash flow generating business, great brands. So very nice stories you can tell about, a Nestle or a Hindustan Unilever and all that. But again, you look at data and you see that theme comes and goes. It is not it's not a theme that runs forever. If you look at Hindustan Lever, from 1999 to 2010, it gave no returns. Bata gave no returns for 15 years. Even Coke, so what happens also is that if you tell a story too many times, you yourself as a storyteller also start to believe in it. So if you look at, Coke is one of Warren Buffett's most well-known investments. But if you look at what it has done for the last 30 years, not 1, 2, 3, 4 years, but 30 years, it has hugely underperformed the S&P 500, underperformed Pepsi even more. So it's, last I saw, it was up some, there was like about a 50% underperformance from the S&P. So the point is that stories are not reality, but by telling that as human beings, you buy into it as the listener and also as the teller of the story, and then you cannot change your mind. The point is that you tell that story too many times, you are invested in that story, and you cannot change your mind. So we always like to look, for example, in the way we manage portfolios, we look at everything from scratch every quarter, and nothing is a holy cow. There's nothing that cannot be touched.
I don't know what worked, the storification or you saying Mera Wala green, etc., or just absolute randomness, as Nassim Nicholas Taleb says. But as soon as we started speaking, we did see the markets move higher, Devina. So we will give credit to you right now. The Nifty's moved into the green. The Nifty bank higher by about 150 points. The mid-cap index has curtailed its losses as well. And the Sensex too has moved closer to the 61,000 mark, just about 50 points away from that. But let's talk about behavioral finance itself. Devina, it's easy to say that in hindsight, data provides a lot of instances where things have survivorship biases, etc. But while you're going through it, it's difficult to differentiate from the individual and the situation that there is. Can you give us some examples of your own where you may have, unknowingly fallen into any of these biases as well?
See, this is a process of learning. When you come into the markets, obviously, you will make mistakes, you learn, you think about how to not make those mistakes, which is why over time we have moved from a human only research and fund management business, or the way we do things, which is the way everybody else still does it. And I love doing it that way. I was one of the first people to start in equity research 30 years ago when the discipline did not exist in India. But over time you realize that now the playing field has changed. Now, earlier you could have an edge by going and meeting a company and getting some differential information. Now, everything from the con call transcripts, everything is public. And here, as well as around the world, there are regulatory changes which mean that no one can get differential information. So now what you have to do is analyze the data. And that is what we found, that the only way to do it in a consistent fashion is to use machines. So which is why we say we have a human plus machine model, where the first filter is an artificial intelligence, machine learning, very elaborate, very rigorous model. It is not a black box. We know exactly what's going in and why it's recommending something. But that's the only way to do it consistently. Because see, I can read all I want about cognitive biases. Daniel Kahneman has won the Nobel Prize for writing about cognitive biases, but he says that even I cannot eliminate my biases. Because see, the thing is that all these biases are very hardwired. They are part of evolution. They were there because they were helping you survive in the wild. It may not help you survive in the stock market. So just by understanding it, you cannot eliminate it. So you have to systematically eliminate it, and the system part is important. So that is why we now extensively use artificial intelligence and machine learning, which can not only crunch a lot of data, but it is consistent, it is bias free, it has no problems admitting mistakes, learning from mistakes. And then you apply some amount of human overlay. But for example, in risk management, we do not apply human overlay,
Right.
because the human instinct will always be to say that I did not make a mistake.
Right.
This time, let's wait a bit, this stock is different, and so on and so forth. So this is an interesting journey.
Devina, make some predictions for us. Non-consensus predictions, which I don't know if you have thought of it. But it's the season for predictions. I know, studying past is much easier and much better than predicting the future. But nevertheless, since we have you on this time of the year, the wilder the better. Go on, Devina.
Okay, so first of all, I have never given a nifty target in my 30 years for either on Diwali or New Year. But the beginning of the year, I had made two big ones. One was that the rupee will certainly depreciate this year, which it did. And the second was that India will outperform, which it has. So out of like 42 country indices, India is number 10. So in dollar terms, we are down, I think, about 4.5% as of yesterday or something like that. Whereas the aggregate global markets are down about 19, S&P is also 19 and odd. NASDAQ is almost at the bottom. Only Sri Lanka is lower at minus 34%. So last year I told people that it's not as if that the NASDAQ will always do well. So that was also part of storification and recency bias, that because it had done very well for 2 to 3 years, you'd say that you're just extrapolating that. India had come out of a very long period of underperformance, both relative to its own history as well as relative to global markets. And the outperformance had only really started in 2021. So I was quite confident it would continue in 2022. As of now, it still looks as if it will continue. So India is still among the better markets in the world. We are watching carefully whether there is some amount of moving of the leadership from US to emerging markets in Europe, which we are just watching to see whether that's like a kind of a long-term change or it's more short-term in nature. And within US, we like non-tech better than tech. So the old-fashioned consumer cash flow, that kind of those kind of stocks are looking better, obviously also because interest rates are going up. So interest rates going up means companies with profits a little further away don't look, or cash flows more further away don't look as good. So that would be broadly. So India looks as if it will outperform for now. Certainly that appears to be the case.
Okay, all right. On that positive note, I mean, we could go on that. It's an interesting rabbit hole to get into predictions, and but we'll leave that. I guess we'll invite you back first week of 2023. It won't be late enough to make those predictions and give you time to think about them as well. Thank you so much, Devina, for joining us today. Great to have you with us here as always. And if you don't see you before the 31st,
thanks for having me.
Yeah, wishing you a very happy new year. Thank you. All right, that's Devina Mehra, First Global, with thoughts on the market. Interesting conversation about biases, human behavior. I mean, that's a bulk of it. The data, the analysis, as Devina pointed out, that is the lesser of it. As we of course all know, the market is, as Mangalam pointed out, up 20 points, 22 points. 18,144 is where we're at the high point of the day, and there's 40 minutes to go for market closing. We are going to take a break. We have another very special guest joining us. Our alpha manager of the day is Aman Chauhan of Abacus Asset Management. He's waiting by with his calls for 2023. Stay with us.